Surprised or not by those comments from the CFO?
Not a big surprise, because we've seen some of the large universal banks such as JP Morgan Chase and Citigroup. In fact, last week Citigroup at the RBC Bank Conference announced that their revenues were going to be down 15 to 18% in trading, and investment banking down 25%. So not terribly, not a big surprise from what we heard yesterday.
So if the likes of Citi and Morgan Stanley are not getting this seasonal bump of new money being committed at the start of the year, does that mean a delay effect, that if there is some confidence building measure, whether it comes from the Fed or something else, the money could be committed later this year?
I think you're right. I think what we could see is, as confidence is built up in the U.S. economy, that it's not heading into a slowdown, but it in fact is expanding, which is what we think will happen. That will bring more money into the market, which will be very supportive of the indices.
What do you make of the volatility that has been cited by so many banks so far, that investors are just simply holding off, and then stock deals not being had, debt writing is not happening on markets, and therefore the overall fees derived from investment banks are simply just not at the same pace?
You're right. The volatility has been very difficult for the marketplace these first 2 months of the year. March has been a little better than January and February, but the global marketplace has been very volatile, with Asia doing its volatility as well. So I think there's a lot of investors concerned about a slowdown in the global economy, but the U.S. economy, U.S.-centric, so far we haven't seen any sign of that slowdown. And in fact, this is the big spring selling season for homes, and housing is a big strength to the U.S. market at this time.
What do you think we're going to see as far as the Fed and rates and its impact on the banks? I know the head of the American Banking Association has been urging the Fed to get on with it, and effectively they just want to improve the look of the yield curve here for the banking industry.
They sure do. In fact, the banks would do very well if the Fed would raise short-term interest rates. We don't expect that type of news today, of course, but there is an increasing probability now that June we could see a Fed funds rate. The Fed fund futures, as recently as last week, was pricing in a 0% probability that the Fed was going to raise rates in June. That is now up to 50%. So for the banking profitability, rising short-term interest rates with the long end of the curve trending upwards would be very profitable for the banks.
Is it your expectation that the curve will naturally steepen on anticipation of these Fed moves here? Because when you look at the way that the US curve mirrors the European curves, we've got a lot of issues in Europe at the moment that are keeping our curves very flat. You'll have seen, obviously, Mario Draghi's big announcement last week.
That's correct. In a normal environment, the answer would be yes. Traditionally, the long end of the curve leads the Fed funds rate. So as the Fed funds rate rises, the 10-year Treasury yield tends to go up first. That hasn't happened this time for what you just said. With the European rates where they are, many investors outside the United States find that 1.9% or so yield of the 10-year very attractive versus what they can get from the German Bund or other types of government bonds. So therefore, it's going to put pressure on that yield curve. It may not steepen as much as it would normally.